It's nice to have you with us this morning, and we lead our coverage this hour with the latest Canadian jobs report and a hot jobs report. At that, Canada's economy added 90,000 positions in April. That blew away Bay Street expectations for a gain of 20,000 jobs. In addition, the unemployment rate, which economists had thought might tick up to 6.2%, remains steady at 6.1%. Now, while this is a strong rebound from what we saw in March, there are some reasons for caution. The job gains were driven by part-time positions. In addition, the pace of hiring failed to keep pace with our rising population. And on wage growth, compensation is rising at the weakest pace in 10 months. All this to say, the door seems to still be open for the Bank of Canada to consider cutting interest rates starting next month. Most economists currently expect the bank to lower its policy rate by 25 basis points on June 5th. That would mark the start of an easing cycle if it happens. This jobs report today is the last one before that rate decision. So beyond this data, perhaps the inflation report we are waiting on later this month will likely be closely monitored on the street. Against that backdrop, we have full coverage of the job story this hour. Joining us here in studio, Desjardins, Chief Economist at Deloitte Canada, as well as Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. Always nice to see both of you. Thanks for joining us. Don, your reaction to the jobs number?
Well, that was a wow. Certainly it was a lot stronger, as you said. Now, you also pointed out it was part-time jobs, which accounted for over half of that. But it was private sector jobs, which has been a laggard. We've seen a lot of public sector jobs being created. Public sector up a little bit too, but private overtaking it this time. I think what's interesting is that youth also saw a big increase. And that's been a sector, a part of the labor market that's been really suffering. Having said that, the youth unemployment rate is, it's close to 13%. So it is still extraordinarily high. So all told, as you say, it's a big wow at the top, but then you look through and maybe not as strong as all that.
Okay, and Earl, how would you characterize the jobs market right now?
Yeah, well, it's an outstanding number. I like looking at this in the context of the U.S. If you say the U.S. is approximately 10 times larger than Canada, this would be the equivalent of a 900,000 monthly gain. That would be on every news headline. And not only would they stop talking about eases, they would start talking about hikes. But in Canada, to your point, like you said, there was this, I wouldn't say it was led by part-time jobs. There was a significant portion of it, more than a majority, 50,000, but there were still 40,000 full-time jobs. That was more than the total number expected.
Yeah. Okay, so what's our takeaway here, Don?
Well, I think, some pockets that had been suffering or underperforming, we're starting to see some pickup. And the hospitality sector in particular saw a big increase, I guess, as we get into the summer season.
Yeah.
But when you look at it year over year, hospitality is still basically flat, so where it was in April 2023. But we also did see, professional services picking up, scientific services. So that's good. That's the area of the economy where you're going to have some high-paying jobs. Good growth there, I think, is encouraging. As you said, the wage growth did moderate, but it's still pretty hot at 4.7, 4.8%.
So, Earl, where should the street land on something like this? And, I think we live next to the U.S., so it's hard not to embrace some of what's being discussed there. To your point, a week ago, we had a weaker than expected American jobs report. It started getting people talking once again around the U.S. cutting interest rates. At that time, heading into this Canadian jobs report, people were saying Canada's a different beast and things are showing signs of cooling here. And if inflation pressures are easing, it's starting to seem like whether the U.S. cuts rates or not, Canada is on pace to be cutting interest rates come June. When you have a hot jobs report like this, what does the Bank of Canada make of it?
Now, a lot of things to dissect there. So let's start with the first one. I think this makes it easier for the Bank of Canada to start in July or even September, which is my base case.
And harder in June.
And harder in June. Having said that, we do have one extremely important number, which you mentioned, which is the CPI number. Unfortunately, our forecasts actually anticipate higher than expected. We're seeing a turnaround on the monthly numbers in CPI, and we expect actually higher than expected. If you do get higher than 2.7%, which is year on year, which is what the market's expecting for CPI, I think that pushes it to at least July. Another thing, and this is why I believe the jobs number is strong, and always remember, this is because of the resilience of the U.S. When the U.S. surprises to the upside economic-wise, we benefit. It's a lag, but now we see it and we benefit. So it's important to remember there's a high correlation between interest rates in Canada and U.S., which just means U.S. has so much influence over and beyond what we see in our own economic data.
And Don, if for now we have a hotter than expected Canadian jobs report, and if the inflation numbers, I don't want to put words in Earl's mouth, but if they prove sticky, what is the reason why we're even talking about, forget about pushing out rate cuts from June to July. Why are we talking about cutting rates right now? What is the concern for Canada's economy?
Well, certainly, I think, if we do see any flagging of the economy, and, you looked at the January GDP, for example, very strong, and February a little less, and March really quite flat. So it isn't all smooth sailing, I don't think, for the economy. And let's face it, the labor numbers are very bumpy.
Yeah.
So, we could bump up and then bump right back down as we move through the month of May. So I would just say that, the economy is, and especially, just bringing out the per capita argument, even when we look at strong population growth, we're still in a pretty sluggish, I would say, mode. This does raise the prospect, though, that the economy isn't going to deteriorate further. But I don't know that it's going to be robustly strong. And so from the bank's perspective, if we're starting to see this excess supply build and price pressures easing, why do we have interest rates at 5%?
To do that, especially if, to your point, you can zoom out, look at all the jobs data, Earl, and if there's a conclusion that things aren't as hot as they could be. And I guess Don mentioning the fact, we said it off the top, we've said it many times, we're in the midst of a population boom in this country, which is an economic helper, but the job creation has not quite matched the growth in the population. At least that seems to be a popular view. You're tilting your head. So
yeah, because
something else from Earl here.
Just speaking, when you actually look at net new jobs in Canada this year, it's 160,000. That's up to April. That's 40,000 a month. I would say 40,000 a month times 12 months, it's roughly 500,000 new jobs a year, which is now matching the expected population. It wasn't matching it at 1 million, but it's matching at 500,000. Going back to the question why the Bank of Canada should ease or consider easing, I do think there's a lot of reasons. Remember, when we're talking about it, we're just talking about one number. We're talking about the average or the median. We're not talking about the dispersion. And there's a lot of people who are suffering, more people that are suffering in regards to rent, food inflation, and the like. Easing will make it easier. Unfortunately, the Bank of Canada only has one tool, and that's easing. They have QE. We'll put that on the side for now. But one tool and easing. If they ease, it could stoke inflation, which means they would have to resume hiking. That is the challenge of having one tool to attack inflation, to attack the economy with.
Okay.